Yeah, good evening. Could you hear us?
Good evening. Yes, yes. Good evening, sir, and all the participants here. And today's webinar is organized by Lawrence Charitable Trust in collaboration with Association of Mutual Funds in India. And today's our topic is strategy for managing personal finance and basics of mutual fund. And today's our keynote speaker, Mr. Brahma Rao sir, and he is a ex general manager of State Bank of India, and presently he is as a senior consultant of Association of Mutual Funds in India, and he has a vast experience in financial and securities market. And so I request today's keynote speaker, Mr. Brahma Rao sir, please start the session, sir, and all the participants are waiting for your session. Please continue, sir.
Yeah, good evening to all the participants. And I thank very much for the Lawrence Charitable Trust for organizing this program for the benefit of all the persons present here. And this is all about the strategy for managing personal finance. And mostly it is, my talk is centered around the mutual funds and the various schemes and structure that is available to all the investors, which is beneficial in managing your personal finances. Basically, as Sabdar has in his opening remarks said that this is being organized by AMFI, Association of Mutual Funds in India, under the aegis of in collaboration with SEBI, and this program is being organized for the benefit of the people present here. Let us start the presentation without wasting our time. Yeah, go ahead, please. Hello.
Please, Nisha ma'am, second PPT, ma'am. Please, ma'am.
Yes, slide, please. Hello.
Yes.
Yeah. Yeah, this when any individual or a business person earns income, this is these are the three ways generally they they spend their money and save and invest. Yeah, this most of it will be spent, and part of it will be saved, and part of it will be invested. So this is the three ways of taking care of our hard-earned money with our blood and sweat. Next. Yeah, if we revert to the the financial guru of international reputation, Warren Buffett, what he says is, do not save what is left after spending. You spend what is left after your saving. That means you have to have a financial goal, and how much you want to save has to be predetermined before your spending starts. So this is very important code. So that means you have to spend only after whatever you have saved. That much only you have to limit your spending habits, so that your future will be much better way. Yeah, next. So when you are doing your savings and investments, one important factor has to be taken into consideration, that is inflationary conditions in the economy. What are the inflationary conditions? We will come to that in the next slides. So, but when you think that you have saved a full apple, but only the portion will be available to you, a slight portion will be taken away by inflationary conditions. So one has to be aware that if there are inflationary conditions, and we have to take that factor into consideration while making our savings over time. Next. So how this impact of inflation will impact our expenses and income is shown in this slide. So if you want to lead a decent, expenses side, let us take it. If you want to a decent standard of living today, as an earner, you thought that okay, 30,000 will be enough to lead a decent standard of living today. But after 5 years hence, what happens is this 30,000 to lead without any change in the circumstances, to lead the same standard of living is not possible, because the inflation will creep on increasing your expenses without your knowledge. So to lead the same standard of living, to meet the same expenses, you may have to spend 40,000 rupees after 5 years, and accordingly after 15 years, 60, 20 years, the same expenditure will cost you 80,000 rupees without any increase. That is the impact of the inflation. Similarly, it has a reverse impact on your income. You thought that you have saved 1 lakh rupees, but unfortunately, over a period of time, what happens? The net present value of that savings will depreciate, and you may not get exactly what you thought you have saved, and the value will keep on decreasing. This is how the inflationary conditions will impact your savings and expenses. So you have to take this factor, very important factor, into account while taking, making your savings. Next. Yeah, what is the solution for this type of, conditions? Is start saving from day one. You cannot, okay, I am a single, presently I don't have much burdens. Why should I bother about savings and investments? Don't think in those lines. You have to start saving from day one, the day you start earning, and progress from saving to investment. That means don't keep everything, under a pillow or in your safe box and other things and thought that you have saved it. But you should see that your savings also earn a decent return for you to make your standard of living much better. And that is what the third point is. Put money to work rather than accumulating or keeping it in a idle. Then you work hard to earn money, so make the money also work hard for you to make your life better. And finally, that important concept is compounding impact. What is the compounding impact? So if you keep on reinvesting the returns also into this, into your savings and investments, automatically the compounding impact will have a very, very decent returns to get a lump sum amount which will require you for your future needs. Next, what is the solution for this? This financial planning is very, very important. What is the financial planning? Define your financial goals from the day you start earning, then and assess your current financial situation. Then go on increasing your investments and other things into various asset allocations, asset classes, so that we must have all heard about one proverb, don't put all eggs in one basket. Similarly, create an asset allocation. You have to spread your investments into various asset classes and invest accordingly. And don't having invested, don't keep idle. You keep on monitor and review your investments, so that the investments how your investments are faring, and whether the desired returns are you're getting or not will be, you have to constantly monitor and review. Next. Yeah, why is important is same thing to achieve your financial goals, because every individual has aspirations. The aspirations has to be defined in terms of goals, and to achieve these financial goals, you have to have a discipline, financial discipline, to save and invest money accordingly. And then
this on the web for define intensive and discipline. Check it out. By the way, if you have another request, you don't need to say Siri.
Enhance your standard of living. This will the financial planning will enhance the standard of living and prepare for your financial emergencies. In everybody's life journey, anyone, everybody, all of us, encounter one sort of the other, financial emergencies like medical emergency or some unfortunate event in the family or celebrations or additions to the family. All these things, keep on happening in the one's life journey. So your savings, your financial discipline will help to meet these unforeseen circumstances, unforeseen events in a much, much better and disciplined way. And also, it will help you in your tax planning, and accordingly, you will have a peace of mind at the end of the day. You need not worry about all this, what will happen and how I have to meet the goals, or what happens to our taxes, etc., etc. All these things will be taken care of, and if you have a financial discipline, and accordingly you a goal-based investment is undertaken by you. Next. Again, reverting back to Warren Buffett's famous quote, never depend on one source of income. That means, okay, I'm getting salary, I am happy with that. No, it's not like that. Your savings and investment should give you a second source of income so that you will have a decent standard of living to meet the financial emergencies and to achieve your financial goals. Next. So, how to achieve those financial goals, and where to invest to achieve, to have a financial discipline and other things, is investing in stock markets is one way of doing it. And this slide shows you investments in shares and bonds in the stock market, how the stock markets are faring, and how much returns they are being generating to the investors is given in this slide. Over a period of time, if you look at it, generally the stock market gives you decent returns, provided you have that appetite and knowledge to study the market well and invest accordingly. If you look at it, 10.4% is the lowest return you got it, and the highest is 16.8%, which is considered to be a very decent return. That's why we say that returns generated by investment in stock market over different tenures will give you a decent return. But only thing is, it is market determined returns, not issued returns. Always you have to remember. And investment directly into stock market also have certain element of risk, unless you are very well knowledgeable and have a good experience in investing in stocks and bonds. Next. The same is given in a graphic form, the way how the Sensex is growing over a period of years, and it's always on the upward trend, except in small dips in the year 2009 and maybe what you call 14, 15, 19 or 20, in that range. But otherwise, it is generating decent returns for the investors. But of course, one has to be very careful when directly dealing in the stock markets. Next. Yeah, this is, your financial goals. Your goal-based investment should be like a plant, you have to nurture it. You have to keep on, reviewing and monitoring your investment so that all your requirements, like, addition to the family and a four-wheeler and enjoyment with family, and to have a house, a decent house, and to meet children education, and finally to have a peaceful retirement life, one has to have financial discipline, and there should be a goal-based investment. You have to choose the asset classes in such a way that you can achieve your financial goals in a more disciplined manner. Next. So what are the options when we have talking about goal-based investments? What are the options available to the investors? These are the options available. You can invest in gold, you can invest in property, stocks, insurance, bonds, and bank deposits. And also, again, there is a big chunk which is mutual funds. This is a very very good investment for the investors who do not have much expertise directly to invest in stock markets and other areas. Yeah, so why this is shown as a big one, and we will come to that in the next slides. Let us go to that. Next. Yeah, that means we always assume and interested in that our return, our investments are going to give us decent returns. Why we want that decent returns? First of all, to fight inflation and provide a second source of income for all of us. And whenever we require for financial emergencies, they are easily accessible and usable, and they should have the characteristics of grow in value as well as give us decent returns. And whenever I require, I can easily liquidate them and realize them to meet my financial emergencies. Next, what is the answer for this? Is the proper asset allocation. Your asset allocation should be like a thali, a South Indian thali. If you look at it, you get all sorts of dishes in that, and if one may not like one thing, but generally everything will be given, a pool of items are given to you, so that you can take whatever you feel preferred and feel to your liking, and accordingly your asset allocation also should be like this thali, so that you have to diversify your portfolio of investments, so that if there is one class is not doing well, it will be compensated by some other classes of assets which will be doing handsomely, and you will get decent returns. Next, please. Yeah, asset allocation should be match your financial goals. You on the left side of it, you have investments shown only in value terms, like gold or a real estate property. If you have invested in them, it won't give you any returns. It keeps on the value may be increasing in over a period of time. Similarly, on the right side, if you look at it, there are some issued returns schemes with like bank deposits and NSE and Kisan Vikas Patra, bonds, etc., which will give you a predetermined return, but they don't grow in value. So, but in between these two, there are mutual funds which has the characteristics of both. Like they will grow in value as well as it will give you a decent return too. That's why one has to ask ourselves, are we investing in right classes of assets? Next. So having said that mutual fund has the dual characteristics of growth in value and also giving returns, let us go deep into what is a mutual fund, how it is structured, what are the various schemes that are available for us. The mutual fund is a financial vehicle that collects money from various investors and invests in securities such as stocks, bonds, and debentures. And anybody with an investable surplus as low as a few hundred rupees can also invest in this mutual fund. The most cost efficient, you don't incur any expenditure, unlike if you want to purchase a plot of land or gold or all these things, you have to incur some expenditure. Similarly, here you don't require to incur land means registration charges or broker charges. Gold means that bullion. Sometimes they will take away for Radhi, and all these things will be there. But whereas here, this is the most cost efficient way of investments, and with very, very little or no cost, you can enter the schemes. And also, you have the advantage of fund managers who are supposed to be experts. These pooled up resources will be put in their hands, and the fund managers will invest on behalf of the investors in various lucrative schemes and shares and bonds, which will generate decent returns. Only rider is, as I said, mutual funds will give you, like in stock market, only market generated returns, not issued returns, like in bank deposits where 7% or 8% is given issued return. And in the long term, if we look at it, the market driven returns are much better than the issued return schemes, if you compare. Next. How does a mutual fund works? When we're talking about mutual fund, which has a dual characteristics of growth in value as well as generate returns for your needs, let us try to understand more deeply into the mutual funds. How it works? There will be pool of investors who pool up their money, and these pooled money will be given to a fund manager who is an expert in investments in stocks and securities, and they will invest in a good securities which will generate returns, and those returns generated by the fund manager through investment of the pooled up resources will be delivered back to the investors net of expenses. This is how the mutual fund work. Next. And why invest in mutual funds? This is because it has what you call 3 plus 4, 7 important characteristics. What is the low cost? You can invest in with as low as 1,000 rupees in multiples of hundreds. Convenient to invest in small amounts. Professional management, because the fund manager is available to you, and as he is investing in various basket of shares and bonds, there will be risk diversification. And this mutual fund industry is well regulated by SEBI, that means the Securities Exchange Board of India, which have a lot of transparency because of the strict regulations. A lot of disclosures are mandated by SEBI on the industry, so the investors can be rest assured that there will be a lot of transparency, and whenever they require money, it can be easily liquidated, and you can get your money within next 2-3 days into your account. Next. Yeah, next. Yeah, how the mutual funds are structured. As the name suggests, a mutual fund, is mutually beneficial. The investors who are pulled up their resources, this scheme is to benefit them through generating decent returns. How it is structured? There will be a sponsor, and the sponsor will not run the company, and there will be a hands-off approach from the sponsor's side. And in between sponsor and the asset management company, mutual fund company, there will be board of trustees who actually run the asset management company. This asset management company floats various schemes and plans for the investors. Whatever it suits, they will, they can choose investors. These investors pull up their resources and invest in these schemes that are being formulated by this asset management company, and the returns that are being generated is being distributed to the investors. And to aid this asset management company, there will be agents and distributors, bankers and fund managers, and these all will help the asset management company to invest in diversified asset portfolios, and with expert fund managers' advice. And there will be again another hands-off approach in this. There will be another person, another entity called custodian. The shares and bonds that are being invested by the fund manager with the pooled up resources are being kept with a third party called as custodian, and the asset management company or the fund manager will not have any direct access to deal with those shares and bonds that are being invested. So this is how these watertight compartments are available to safeguard the interests of the investors by the regulator, that is SEBI. So rest assured, your investments are in safe hands. Next. Yeah, types of mutual funds. If you look at it, there are various types of mutual funds based on 5 types: organizational structure, management portfolio, investment objective, investment portfolio, and other fund types. These are the various fund types. Let us go each one into. To know much better about the mutual funds. Next. Categorization of mutual funds, or the mutual funds are categorized into the types that we have seen, and these types are categorized into various schemes. Those are the schemes called equity schemes, debt schemes, hybrid schemes, and solution-oriented schemes, and other schemes. Equity is, as the name suggests, mostly predominantly the investment. The pulled up resources will go into equity shares. Debt schemes means predominantly the investments go into debt securities, government securities, debt, funds, etc. And hybrid schemes is a combination of equity and debt, and part of it will go to equity and part of it will go to debt schemes. And the solution-oriented schemes are known as if you want to have a retirement fund and you want to, at the time of your retirement, you want to have a decent lump sum amount to supplement your retirement needs, and this solution-oriented schemes will be beneficial. Similarly, children education fund is also another solution-oriented schemes. Other schemes are, it is linked to the index funds and exchange traded funds and fund of funds, etc., where they generally don't take much risk. They will directly tag with the index-related shares only. And these are the various categories of mutual fund that are available to the investors. They can choose as per their risk appetite. And here the risk is always, one has to remember, the higher the risk, the higher the return. Similarly, moderate the risk, the returns are also moderate. Similarly, whatever the investment risk appetite the individual investors are having, they can choose their schemes accordingly. Means what we are trying to tell is, you have various options available to you depending on your requirements. Next. Yeah, let us go deep into each of the schemes. Let us see equity schemes. Equities is, the schemes is invest in equities and equity related instruments of companies, seek growth in the long term, and can be volatile in the short term. You have to investors with a longer horizon can go into this type of schemes, equity funds. Next. And in this, the various schemes that are available is multi-cap, large cap, and large and mid-cap. Cap means what? Capitalization. Capitalization means the value of the company in the market, how the market is viewing a certain company. That is called market capitalization. In the sense, the face value of share may be 10 rupees, but in the market, if the share is trading at 100 rupees, at 110 rupees, the market capitalization is that 90 rupees, 10 rupees share, 100 rupees. That means you will have that market capitalization is 90 rupees. Similarly, this market capitalization deals with the equity funds will go into defined market capitalization funds. They design schemes wherein they can invest in different types of market capitalization companies. So these are the various categories that are available for the investors to choose as per their risk appetite. Next. Similarly, equity fund categories are dividend yield fund, value fund. These are again another category where predominantly invest in dividend yielding securities, as the name suggests. And value fund means it is value investment strategy. They grow in over a period of time. Not much of a returns will be given. Similarly, is various schemes that are available for the investors to suit their requirements. The last one is important. ELSS, equity linked savings scheme. 80% it goes into the equity linked savings schemes, and accordingly, but only one rider here is the investments under this scheme are locked in for a period of 3 years, because these are all new companies, and there is a lot of tax rebate that are available, comes with this scheme. Next, let us see what ELSS are all about. So ELSS is reduction from taxable income up to 1,50,000 under 80C is available predominantly in equity and helps generate market-linked returns, and the shortest lock-in period of 3 years as compared to other tax-saving options. Okay, these are the characteristics of a ELSS. If you are going for ELSS schemes, you have to you should know about what exactly is it coming with that scheme. Next. Yeah, having covered the equity schemes, let us go into debt schemes. The debt funds are invested in different types of fixed income securities, and the objective is to earn interest income for the investors, and suitable for the investors with low to moderate risk appetite. I mean, I don't want to take any risks even in mutual fund schemes, so I will go for debt schemes, so that there will be almost returns are quite assured in this. Next. So this is in the matrix that was given, low, x-axis, duration and maturity period of securities in the fund, and the risk appetite, on the y-axis is given. So various fund schemes which are available with these characteristics are shown in this, and you can choose whatever is suitable for your risk appetite. Yeah. Next. This is debt fund categories are there are again several categories are there in this. As low as 1 day also you can park your funds in debt fund categories. Overnight funds, liquid funds is up to 91 days, and short duration fund is 91 days to 6 months, and low duration is up to 1 year, and money market fund is up to also up to 1 year, and 1 to 3 years is short duration fund, and medium duration is 3 to 4 years. 4 to 7 years is medium to long duration schemes. There are various fund categories under debt schemes are available for the investors, so that they can choose as per their requirements of funds and also their risk appetite. Next. Yeah, this is again given in these funding categories where it is available. The securities with the Macaulay duration of 7 years, long duration fund, dynamic fund, across durations they will invest. These are the characteristics of the schemes where the characteristics where they are going to invest will be upfront known to the investors, and accordingly the investor can choose the schemes. Like corporate bond, 80% of the investments in corporate bonds only with AA plus rating. This is how the investments are being made, and which will be told to the investors upfront, so that they can make an informed decision. Next. Hybrid schemes, as the name suggests, it's a combination of equity and debt schemes. Let us see how it is structured. Next. Hybrid funds are investments in a mix of equities and debt, and aim to generate wealth from equity exposure, while the debt portion fortifies the against any downturns. Suitable for investors looking for a mix of safety income and modest capital appreciation. This is how the hybrid funds are structured. Next. And hybrid funds, various categories, 7 subcategories are available to you in this: conservative hybrid, balanced hybrid, dynamic asset allocation. Because portion will be go to equity and portion will be this. Various schemes are available to you, and the investors can choose one of the schemes which will suit their risk appetite as well as their investment return requirements. Next. Then solution-oriented schemes are available. That is retirement schemes and children education funds, etc. Let us see. Next. So retirement funds, lock-in period for at least 5 years until retirement age, whichever is earlier. And children education fund also similar, lock-in period of 5 years. And index funds and ETFs are minimum 95% investments in securities of a particular index, maybe Bombay Stock Exchange or NS National Stock Exchange, etc. Fund of funds is minimum 95% investments go to other fund categories. So that these two are actually index funds and fund of funds are passive investment funds. They call it not much of a work because they only trade in the index related shares and bonds. So not much of a risk. Whatever the index is generating returns for the investors, similar returns will be given to the investors in these schemes. Next. Index funds portfolio replicates the index and aims to provide returns in line with the index, suitable for investors seeking returns similar to the index. These are the three important characteristics of index fund. Next. Yeah, index funds, again, the characteristics are given in 6 characteristics. Mirrors a market index like BSE or NSE. Includes the securities as per index. Whatever the index having a basket of shares, in similar shares, the same shares these funds also invest. So, and the passive fund management, not much, because the basket is defined by the stock exchanges. We are investing in the same stock exchange shares, so not much of an active fund management is required here, and returns are in tune with the index generated returns. And because there is a passive fund management, the expenses are capped here, and the complete transparency in working of this scheme is available for the investors. Next. Similarly, exchange traded funds also is a passive fund management and tracks an index, commodity or bond or basket of assets. So accordingly, the investments will be made by the fund manager. So not much of an expertise is required here. So the cost of fund, lower cost of fund management than active funds. Next. Yeah, this is another category, gold exchange traded funds. These are all, either in, they invest in physical gold bullion of 99.5% purity or gold related instruments approved by SEBI and gold deposit schemes of the banks up to 20% of its net assets. This is how the gold traded funds work. Each unit of gold ETF represents a defined weight of the gold, typically 1 gram. The price of gold ETF unit moves in line with the domestic price of the gold, because the pricing of these, automatically the value of that unit will move as per the domestic price of the gold, benchmarked against the price of the gold, considered as a non-equity mutual fund for public purposes. It's not equities. No, they are not investing in equities or shares or bonds. They're only invested in gold, pure bullion or gold-related instruments. Next. Yeah, next, please. International funds. International funds are another category of funds where the Indian multinational companies which are listed abroad, like in New York Stock Exchange, NASDAQ, or Japanese markets, or London Stock Exchange, etc. They generally, because our shares are denominated in rupees, you cannot directly trade in in the international markets. But these companies issues ADRs and GDRs. ADRs means American Depository Receipt for New York Stock Exchange, American markets, whereas GDRs are Global Depository Receipts are for other international markets. And these funds will invest in these ADRs and GDRs, and accordingly, the market-related returns that are generated by these ADRs and GDRs are being given to the investors and units of passive index fund in other countries. So, see, this is all categories of these are called exchange-traded funds. Also, the international funds. Some debt. They also hold some debt and invest in money. Characteristics of that scheme. Next. Fund of funds is again another, passive fund management, where the pooled up resources are invested in the another mutual fund schemes. Like if a fund of funds is floated by, say, HDFC fund, and this fund will invest in SBI mutual fund schemes, or ICICI mutual fund, or Kotak Mahindra, or Birla Sun Life. All these things, they pick up the schemes which are doing very well in the market and invest in those schemes instead of directly investing in shares and bonds of the companies. So this is called fund of funds. This is also a passive fund management. But for the investors, you will get two expertise, two fund managers expertise. Original, the fund manager, where the funds which are investing in shares and bonds and doing very well, and your own fund manager who is picking up those schemes and investing in those schemes. So the expertise of two fund managers is available to the investors. Next. And arbitrage funds, as the name suggests, arbitrage means take advantage of the differentials in the market conditions, two different markets, and the funds will buy where the market is very lowly traded, and sell those the lowly purchased shares and bonds into higher priced stock market, where the price is going much higher. The differential between the low and high market conditions is called arbitrage, and there are specific schemes will be floated by mutual funds to take advantage of sell low and buy high, buy low and sell high is the concept in this category. Next. And mutual fund schemes which want to buy is again is a risk and return trade-off. The higher the risk, the higher there will be the return, and the low to moderate, you have to choose between equity schemes, debt schemes, hybrid schemes, all these schemes. The equity schemes, if you look at it, higher returns, high risk, and hybrid schemes, moderate risk and moderate returns, debt schemes, low to moderate returns and low to moderate risk. So this is how the mutual fund schemes are designed. Next. So having verified the various schemes that are available for the investors, let us see the documents that are available for the investor to study before investing in these schemes. One is SID, Scheme Information Document, where it comprehensively gives the information about the entire scheme. Before investment, the investor should read this SID and its investment objectives, fees, asset allocation, etc., and accordingly take an informed financial decision. Statement of additional information is, it tells about the tax planning and legal issues, general aspects of a mutual fund. This is also a very important document for the investors to before they take a investment decision. KIM is Key Information Management Document Memorandum, is like scheme information document. It's a shortened version of the SID and gives you the important information which is required by the investors before investment. And instead of reading the entire comprehensive document, if you go through the KIM, is more than enough for investment to take an investment decision. Next. Another important aspect mandated by SEBI and the regulator is a fact sheet. Each scheme has to, on a monthly basis, a fact sheet has to be published by the scheme, and where they have invested, whether the investments are in tune with the investment objectives that were given to the investor before launching the scheme, and while launching the scheme rather, and what is the risk that is available to you. Everything is given in a fact sheet. Every month the scheme has to give the fact sheet indicating the NAV, the riskometer, the returns, etc. Full information is given in that. The monitoring and review, what we have thought of in the beginning, fact sheet will help you to monitor and review your investment objectives. Next. Plans and options are there are two plans options available to the investor. One is a regular plan and the other one is a direct plan. A regular plan is directly investment through an agent or a distributor, and here, because the distributor is entitled to have some portion of the commission from the investments pooled by him, so there are expenses will be slightly higher. The NAV will be slightly lesser, and compared with the direct plan, where the direct plan involves directly, like in internet banking, you go to the scheme and invest directly from your account. So there is no third party, there is no commission involved. Yeah, here the NAV will be slightly higher and the expenses are lower. You have to choose one of the plans that are available to you to invest in mutual funds. Next. And the options available to the investors are, the growth option is one, that's compounding impact, and the other one is IDCW option, income distribution and capital withdrawal option. And depending on your financial requirements and your financial goals, you can choose the option that is available, both the options, one of the options available to you in the scheme, and accordingly, the returns will be reinvested or paid back to the investors, along with some capital also. Next. So modes of investments, there are several modes of to invest in mutual funds. One is a lump sum investment. The other one is a systematic investment plan, and systematic transfer plan, and the interest scheme switches. These, let us understand, lump sum investments, we need not, it doesn't require any additional information. You just put a lakh of rupees or whatever, some lump sum in the scheme, and that is called a lump sum investment. Whereas systematic investment plan is like a recurring deposit of a bank, where every month you keep on investing a predefined amount, and you can keep on increasing, investing in the scheme on month-on-month basis through systematic investment plan. And a systematic withdrawal plan and transfer plan is transferring a certain amount from one mutual fund scheme to another mutual fund. Say you have invested in one mutual fund scheme that is generating returns, and you may give an instruction to the mutual fund scheme. The returns that are being generated under this scheme, originally invested by you, will be transferred to another scheme on a quarterly basis or a half-yearly basis. You can give those instructions to the mutual fund. That is called systematic transfer plan. Interest scheme switches is, say you have invested in State Bank of India mutual fund. You thought that the scheme will do well, but you are not happy with the returns that are being generated. Only then you can instruct the mutual fund, okay, my entire corpus lying in this scheme may please be transferred to another scheme. You reinvest in another scheme which is being operated by you. So that is also possible, but only thing is, rider is that you can interest scheme switches is only option is available only within the company. That means either HDFC, ICICI, or SBI, you can switch from one scheme to other scheme of the particular company. You cannot from ICICI to HDFC or HDFC to SBI. You cannot do that way. That is called interest switches, scheme switches. Next. So systematic investment plan is in detail was given. Allows investors to regularly invest in a fixed amount in a mutual fund scheme. This is like a bank's recurring deposit. The advantages are regularly you can invest on a regular basis, month-on-month basis, and predefined amount, and smaller installments you can pay, and it averages out the cost of investment, and your NAV will also, the expenses, NAV, everything will be averaged out, and there is no need to time the market. Oh, the market is going up or market is going down, then only I want to invest. Because it's a SIP in a regular basis you are investing, you need not time the market. Next. Yeah, this compound, the power of compounding is also available in SIP. That means you are regularly investing on a month-on-month basis. So your the impact of compounding is available to you. Here, if you look at it, if if you have given a SIP of 1,000 rupees at 8% per annum till the age of 60, if you are investing it, so at the age of 25, if you have started your investment, what you have invested is 4,20,000, whereas the corpus what you are getting with the compounding impact is 23 lakhs plus. And similarly, at various ages, if you start investing, the returns that are going to be generated by the compounding impact through SIP is given here. And the sooner you start, that is what's important. If you look at this 25-year age fellow who started, is getting a substantial amount by way of a corpus. Next. So SIP also will risk-proof you from various market conditions like rising market, falling market, and volatile market. So because you are investing on a regular basis, month-on-month basis, everything is averaged out, cost per unit and average NAV, everything. In all the market conditions, when an investor is choosing to invest in SIP, it gives much better NAV and cost will be less in this. Next. Systematic withdrawal plan is again, it allows an investor to regularly withdraw a fixed amount from their mutual fund schemes. The desired amount is credited to the investor's bank account by redeeming liquidable units, and it aids retirement planning and also provides a regular cash flow to the investors. SWP also helps in supplementing your regular salary income, as it helps you as a second source of income when you are in service. Next. How to invest in mutual funds is given in detail. Next. And the prerequisites, as we are all aware, KYC, know your customer process, is very important. To open any bank account, also you have to. I need not dwell much about this scheme because everybody is aware of this. Prerequisites. KYC, PAN card, your ID proof and address proof, and then you submit all those documents. And this there will be a third party which will vet your the documents submitted by you, and once that is vetted by that, you can start investing in KYC. There will be a central pool of KYC. You need not complete your KYC formalities for each and every scheme, and once this KYC is approved by the central registry, you can start investing. And unlike in bank deposits, where in every bank you have to when you open an account, you have to complete the KYC formalities. Unlike that, this is a centralized pool is available to you. You can, once it is completed, you can choose any company's mutual fund scheme and accordingly you invest in it. Next. Yes, KYC, again, the same thing that is being explained here too. And next one. Next. Yeah, mode of investments is physical mode and online mode. And physical mode is through by submitting an application through a distributor or an agent or a bank. You give your check along with the application, and then this is the physical mode. Only thing is, as we already discussed, a regular plan, where the cost will be higher because the commission to the distributors is also here. Online mode is it's like an internet banking. You can directly, once your KYC is completed, you can directly access the schemes of various mutual fund companies and accordingly invest it. Here, the expenses will be less. There is no commission involved. So your NAV will be higher and expenses will be lower. And offline and online, same thing is explained here. Offline is through agent and online is through directly investing in this. Yeah, next. Next. Next, please. Next. Yes, performance evaluation principles are also available for the investors. You can evaluate the performance of your schemes that are being invested. A mutual fund provides relative return with respect to its benchmark, and the returns have to be compared with the fund's benchmark. Appropriate benchmarks should be used to evaluate the fund's performance. This is how equity funds benchmarks are different, and debt funds benchmarks will be different, and you have to compare your scheme's performance along with this type of benchmarks that are given to you. Next. Stress testing is also available under various market conditions. It's a simulation exercise. How your scheme is performance, how your this thing is company performance is being done through stress testing mode, and it's a simulated method to test how investment portfolio is performing under various extreme conditions. It aims to measure the impact on a fund in case of a significant large amount of portfolio needs to be liquidated in a very short time, and is based on the latest real stock data and is updated every month on the AMFI website for mid and small caps. It is only a measure of resilience of a portfolio based on certain assumptions. Certain assumptions is very important and may or may not behave the same in actual or future market conditions. So stress testing is only an indicator for the investors to take an informed decision as regards to his investment objectives. Next, please. The net asset value is another important concept that is available for all the investors. Means whatever the pulled up resources are there, they will be invested in various equities and bonds and securities, and the value of those securities at different points of times at a monthly intervals on a day-to-day basis, it will be evaluated based on the market conditions, and the expenses so far incurred will be deducted from that valuation and divided by the number of units that have been issued by the mutual fund scheme. You will get NAV, and this NAV is available on the AMFI website as well as even the company's websites also, and people will be knowing how the scheme is performing in the real sense. Next. Product labeling is also done in these mutual fund schemes, and when a scheme is floated, there will be a concept called riskometer. It tells you what is the risk that is involved in that scheme, whether it is a high risk scheme or a moderate risk scheme or a low to moderate. All these things will be given in the labeling that is called riskometer. And by studying that riskometer, you can take your investment decision. Next. Nomination facility is also available for the investors. Like KYC, nomination is also mandatory nowadays. And up to 2 to 3 people you can nominate. And in the event of an unfortunate event, the transmission of these mutual fund units will be easily transmitted to the nominees that are given in the nomination form at the time of joining the scheme. So it is very, very important and mandatory nowadays. Next. Yeah. Why is nomination important? To easily transfer, cost efficient way. You need not incur so much expenditure to monitor this nomination, to transmit these shares into the nominees' accounts or nominees' names. It will easily facilitate the transmission. Next. Another important aspect is there is a complaint redressal mechanism that is available for the in the mutual fund schemes, and the name of the officer concerned, grievance redressal officer, his telephone numbers, everything is very much publicized. In case you have any issue, you can raise a complaint with them, and your complaint will be redressed in a time-bound manner. Next. And SEBI also has a complaint redressal mechanism available in the form of scores. So SEBI complaint redressal system. It's an online method, and in case if your complaint is not redressed by way of by the mutual fund scheme, you can directly write a complaint in the scores system, and SEBI will take care of the complaint, and your prompt response will be given by the scheme. Next. There is an app called Sarathi app, which is launched by SEBI. It gives you wonderful information about financial literacy, financial education, and resources available to all the investors. Objective information is given, and you can have your financial health checkup by going into this. SEBI Saarthi app, and which is very, very helpful tool for all the investors. With this, I stop here. And thank you very much for your patient hearing. And only rider is, as I said, mutual fund investments are subject to market risks. Read all the scheme-related documents while investing. We have already covered all those scheme-related documents. It is for you to take an informed and conscious decision where to invest and how to invest. Thank you very much. If you have any,
thank you for so thank you for today's wonderful session about mutual funds and types of mutual funds. And dear participants, if any questions about mutual fund or any other query, please write your questions in chat box. Chat box is enabled. So I request all the participants, and feedback form is also submitted in chat box, and within 10 to 12 days, we will issue e-certificate to all the participants. If any question, please write in chat box, please. Sir, no question from participant side.
thank you. Thank you very much. And,
sir. Sir, one question is, please explain the first and second slide content again.
First and second slide content.
Yes. If possible, sir.
Can we? First and
sir, one more. Yes. Sir, one more question, sir. Please provide mutual fund service providers address or contact number.
Mutual fund service provider generally, in each of the towns you will have that agents and distributors are located. Mutual fund distributors. You can contact them. Even the fund mutual funds also have their offices in major towns and cities, and you can not one number is available. Several numbers depending on the place of your where you are located. You can contact them, and even in the skin mutual fund companies website also you will get all the information to get the the numbers and other things. As regards the first question, when anybody is earning
second slide.
Yeah, when anybody is earning money, what you will do when you start earning money. First thing, what is you first try to have a good standard of living, and that means most of it is spent. The remaining portion, what you will do, maybe if you are earning a lakh of rupees a month, say 50,000 will go into spending, and the remaining 50,000, what you will do, you will save it. Saving means maybe for liquidity purposes, maybe out of that, the remaining 50,000, you put 20,000 in the savings bank account, and the remaining 30,000 investment in mutual funds or in various schemes that are available to you. A market growth in which you can grow in value, or which can give you returns, or which is having dual characteristics like mutual funds, where the mutual fund can grow in value as well as it gives you a decent return. The second source of income. That's what Warren Buffett has said that. The next slide. Next slide is Buffett's quote: "Do not save what is left after spending." Always remember that. Whatever you spend, say same example, 1 lakh rupees you are spending. You're earning money monthly, so you just keep on splurging on your some of it on necessity and some of it on luxuries and enjoyment, etc. And okay, I spent 80,000 rupees, only 20,000 rupees available. Okay, this 20,000 I will save. No, don't do that way. That's what their meaning is. First, you decide your financial objective. Yes, every month out of 1 lakh rupees, I have to save, come what may. I will save 50,000 rupees out of this 1 lakh rupees. The remaining 50,000 only I will, compress my needs, and I will accordingly spend only 50,000 rupees. The remaining 50,000 will be partially I will, put it in savings bank account to meet my urgent requirements, if any, in the case. And partially, most of it will be invested in various, asset portfolios, so that it will give you a decent second source of income for you to supplement your regular income, and which will give you to take care of the inflationary conditions in the economy, and also to get you a better standard of living. These are the impact or import of these two slides is this. Anything more, sir?
Thank you, sir. Sir, one more question, sir. Is there get profit in mid-cap fund?
Sorry, mid-cap fund?
Sir, is there get profit in mid-cap fund?
Mid-cap, see, again, mutual fund investments are market related, returns only will be given. Mid-cap, if the mid-cap, as per the investment objective, mid-cap means what? The companies which are being not in the large cap basket, not in the low cap basket. It's only middle segment, where decent returns are being generated by these companies, and that type of companies are called mid-cap companies. Capitalization, where the capitalization is decent, the returns are also slightly relatively decent returns are being generated by these companies. Accordingly, if you are investing in mid-cap companies, automatically you will be getting to moderate to high returns. If not, high returns, at least moderate returns you will get, subject to market conditions. Yes.
So last question, sir. How to invest in gold fund?
Gold fund is an exchange traded fund. You can, again, gold traded fund. It is, most of this mutual fund schemes are mutual fund companies are having these gold fund schemes, and you complete the KYC and other formalities and go to the site. You will get the gold funds schemes. You can, because these are all exchange traded funds, you can directly purchase from the market also. And also, or else you can directly go to the scheme mutual fund company's website and purchase it. There are the two ways of doing it. Or through agent, third way. Yes.
Sir, thank you, sir, for today's wonderful session.
Thank you, sir.
And we are also thankful to all the participants for joining today's session.
Thank you, sir. Thank you very much. Shall I leave?
Thanks. Yes, sir. Yes, sir. Okay, sir. Thank you.